Let me start with a number. $71.54. That is where silver just closed in Shanghai. Now here's the second number. $69.57. That's the price at the same moment in New York on COMEX. A $2.53 gap. Let me repeat that. A $2.53 gap between East and West in the most globally traded precious metal on Earth. And here's the question you should be asking right now. Why hasn't Arbitrage closed it? Because under normal circumstances, it would have vanished in minutes. But this time, it didn't. And that tells us something far bigger is breaking beneath the surface. Part 1. The anomaly that shouldn't exist. Silver is not a niche asset. It is traded 24 hours a day, across continents, across exchanges, across time zones. Under normal market conditions, a price gap like this is free money. Buy silver where it's cheap, ship it where it's expensive, lock in profit. That is how markets self-correct. That is how arbitrage enforces truth. So when Shanghai trades at $71.54 and COMEX sits at $69.57, arbitrage desks should be swarming. But they aren't. And that is the first red flag, because arbitrage didn't just hesitate. It failed. Part 2. Why arbitrage is broken. To arbitrage physical silver, you need one thing. Metal, not contracts, not promises, not ETFs. Physical bars that can be delivered, shipped, insured, and received. And that's where the problem begins. COMEX reality. Check as of this week, COMEX registered silver, metal actually available for delivery, is hovering around 100 million ounces. Now compare that to open interest. Over 900 million ounces in paper claims. That's a 9-to-1 ratio, meaning for every ounce of silver that could actually be delivered, 9 different parties believe they own one. That system only works if almost no one asks for delivery. And right now, people are asking. Part 3. The missing metal problem. If Western vaults were full, arbitrage would be easy. Pull metal from COMEX, ship it to Asia, capture the $2.53 premium. So why hasn't that happened? Because the metal isn't there, not in deliverable form, not in sufficient quantity, not without triggering a visible inventory collapse. This isn't theory. This is behavior. Markets don't lie. They reveal stress through what doesn't happen. And the failure to close this gap is the market quietly admitting the West is short physical silver. Part 4. Shanghai is setting the price. Now, let's talk about China. China consumes 25 to 30% of global silver demand, but that number understates the reality. Because China's demand is not investment-driven, it's industrial. Solar panels, electric vehicles, power grids, electronics, and here's the critical word, inelastic. Manufacturers don't stop production because silver gets expensive. They pay more. Because shutting down a billion-dollar production line costs more than paying an extra $5, $10, even $20 per ounce. That's why Shanghai is bidding aggressively. They are not speculating. They are sourcing survival inputs. And when industrial buyers dominate, price behaves very differently. Part 5. The December 22nd. Failure. Let's rewind to December 22nd, Friday. Banks attempted what traders call a paper smash. Large sell orders, thin liquidity, holiday conditions. This tactic has worked for decades, but this time it failed. Silver dipped briefly and then snapped back violently. Closed higher, strong, unshaken. That's not normal. That's physical demand absorbing paper selling in real time. And once that happens, paper loses control. Part 6. Lease rates are screaming. Now let's talk about something few retail investors track. Silver lease rates. Lease rates tell you how desperate the market is to borrow physical metal. Normal silver lease rates hover near 0, 1%, 2%, sometimes less. This week, reports surfaced of lease rates spiking toward 39%. That is not a market functioning normally. That is a market screaming for metal. When lease rates explode, it means someone needs silver now, not next month, not rolled, not cash settled. Delivered. Part 7. Paper versus physical. The divorce. For years, silver pricing has been dictated by paper, futures, swaps, ETFs, unallocated accounts. But physical buyers don't care about paper pricing models. They care about delivery. And that's why the Shanghai price matters more than COMEX right now. Because Shanghai reflects physical settlement. No leverage, no roll, no illusion. Just supply and demand. And supply is losing. Part 8. Structural deficit. The silent killer. This isn't a one-month issue. The silver market has been in a structural deficit for years. Mine supply is flat. Most silver is a byproduct. You can't ramp production quickly. Meanwhile, demand keeps rising. Solar installations, AI data centers, EV infrastructure. Year after year, inventories are drained. And now we're at the point where there's nothing left to buffer shocks. That's why prices gap. That's why arbitrage fails. That's why paper cracks. Part 9. China's January 1st. Export controls. Now add the catalyst. January 1st, 2026. China implements strict export licensing on silver. Every ounce requires approval. Why does that matter? Because China controls the majority of tradable silver, not total reserves, tradable flow. This isn't a ban in name, it's a choke point in practice, and it means Western markets lose their emergency supply valve. And once that happens, delays disappear, and markets survive on delay. Part 10, historical context. Why this isn't 1980. People will compare this to 1980, the Hunt brothers. That was a leveraged corner by two individuals. Regulators changed rules. Margin requirements spiked. The players were bankrupted. This is different. Today's pressure comes from industrial users. State policy, structural deficits, physical scarcity. You cannot margin call China. You cannot bankrupt an industry. You cannot legislate silver into existence. That's why this matters. Part 11, price targets. Scenarios, not hype. Let's talk about price, but let's be precise. These are not predictions. They are scenarios, outcomes that logically follow depending on how stress propagates through the system. Markets don't move because someone believes something. They move because constraints force adjustment. Near term, $72, $73. The first scenario is the simplest. No panic, no headlines, no systemic failure, just arithmetic. Shanghai is already trading silver at 71.54. COMEX is sitting at 69.57. That 253 gap should not exist in a functioning global market. Closing that gap does not require optimism. It does not require speculation. It requires only one thing, the price in the West catching up to where physical metal is already being bid in the East. This is not bullish. It is mechanical. And until that gap closes, the market is signaling unresolved stress. Medium term, $90, $100. The second scenario assumes something very important. Orderly markets, no delivery failures, no panic buying, no cascade of forced covering, just a normalization of historical relationships. At current gold prices, a reversion of the gold-silver ratio toward long-term averages places silver comfortably in the $90 to $100 range. This assumes gold holds its ground. Paper markets continue to function. Physical stress remains managed. Even in this conservative framework, silver's current price does not reflect equilibrium. It reflects suppression under strain. Longer term, $150 to $200. This is the scenario people struggle with because it sounds extreme. But extreme outcomes don't come from speculation. They come from scarcity. If physical stress escalates, if delivery failures emerge, if industrial users begin to front-run future supply, price must rise high enough to force someone to stop buying. That is how shortages end, not through balance, not through negotiation, but through rationing. Industrial demand does not politely step aside. It competes. And when competition replaces complacency, price discovery becomes violent. This is not theory. This is how commodities behave when inventories fail. A critical point to understand shortages do not end when price becomes expensive. They end when price becomes unaffordable for the marginal buyer. That is why these scenarios exist. Not because silver should be higher, but because the system may require it to be. Part 12. Risks and reality. Check now, a necessary pause. This market will not move in a straight line. There will be pullbacks. There will be violent intraday reversals. There will be engineered fear designed to shake weak hands. Paper markets do not surrender control quietly. They defend themselves with volatility. But volatility is not weakness. In fact, volatility is often the first visible symptom of structural stress. Calm markets are confident markets. Chaotic markets are constrained markets. And right now, silver is showing signs of constraint. Part 13. What this means for investors. This is not a trader's market. It is a positioning market. In structural breaks, vehicle choice matters more than entry price, because when systems strain, risk migrates. Physical silver removes counterparty risk. You either hold it or you don't. Unhedged miners offer leverage to price. They amplify moves, both up and down. Paper instruments, however, carry settlement risk. They rely on trust in a system that is visibly under pressure. This is not about chasing upside. It is about reducing exposure to failure points. Part 14. The window is closing. Most people won't see this until it's obvious. They won't act when the gap exists. They'll act when it's gone. By then, the arbitrage will have closed. The metal will be difficult or impossible to source. The price will already reflect the new reality. That's how asymmetric opportunities work. Quiet first, violent later. Conclusion. Physics beats paper. Let's bring it home. A $2.53 gap, 71.54 versus 69.57, East versus West. Arbitrage failed, paper cracked. Physical demand asserted control, This is not a chart pattern. It is not sentiment. It is not hype. It is a structural shift. And when physical reality collides with paper leverage, physics always wins. The only remaining question is not if silver reprices. It is how fast and how far once denial finally breaks. If this analysis helped you see what others are missing, like the video, share it, subscribe, because this story is unfolding in real time. And when the system finally admits the truth, it won't wait for permission.